this episode of The Art of Boring, we take up the main questions on investors' minds today. We'll discuss geopolitics, inflation and bond markets, gold, software businesses, and how the changing world order may affect portfolios over time. It's a broad set of topics, but they all point to the same challenge: how to stay thoughtful in a more complex environment. Stu, another quarter in the books. Nice to see you again.
Good to see you. Thanks for having me back.
I think we have to start with geopolitics for this quarter. That certainly dominated headlines, dominated markets. We started, it seems like a distant memory ago, but we did start the quarter with sort of the events in Venezuela. There was, I guess, the brinksmanship or whatever you want to call it in Greenland. But of course, really what's sort of dominated the market narrative over the quarter and really impacted markets is what's happened in Iran with US and Israel, and in Iran in the ongoing war. Why don't we start there? If you can give us a little bit of a sort of lay of the land as to what's happened, where we're at now, and then what sort of the market implications have been from some of those events.
Sure. I think we're sitting at today at April 10th, day 41 since the conflict in Iran began. The impact on markets, I think, comes down to one thing: it's oil and oil shock, and potentially, I guess, what that means for growth or inflation, or both. Maybe the worst combo, like a stagflation type of environment. We can maybe talk about that. But yeah, one original market expectations, I guess, going to this was, a very brief conflict, 1 to 3 weeks, and we're clearly past that. The last few days, there's been a 2 week ceasefire that's put on the table, and some legitimate doubts about whether that holds up or not. I guess we'll kind of find out sooner than later. And I think it's important, not just from an oil perspective, as you talk about, how markets care about this. I think, global growth could be impacted the longer this carries on, because it's not just an oil story. The Strait of Hormuz, which we're talking about, carries a lot of global oil and gas. So, a fifth of, daily consumption or daily demand. A lot of seaborne fertilizers as well go through the strait, as well as sulfur and other chemicals and products that are used in like semiconductor manufacturing, right? So there's a lot of implications beyond just, energy, food security, supply chains, potentially AI build out. So, some real world examples of like how this is coming home and hitting is, Exxon has lost, quoted as losing 4% of its global production from Gulf LNG plants. I believe Delta Airlines talked about a pretty big jet fuel bill of like $2 billion. Dubai property developers are seeing their bond yields really rise too, right? As a sort of default risk rising. So it's been multi-asset, cross-asset impact, but so far, we're seeing the conflict sort of come back and rise at certain times, but it's certainly day to day, and even has been the last couple of weeks, hour to hour at times. So
Yeah, it's amazing. Despite all that, you would think the markets would have sold off more. I guess they did briefly in March. There's been a bit of a rebound already in April. You alluded to the ceasefire. I guess potential ceasefire that certainly helped the last little while. But it is quite amazing though when you think about, to your point, all of the different impacts, all of the different, whether it be business models, commodities, sort of second and third order effects, and yet the markets have largely held in there quite a bit. You alluded a little bit to, or you made a reference to stagflation. So I guess if you can maybe just, I wouldn't, if you don't mind, maybe expanding on that a little bit, because that is the big risk, right? Like you've got this. Well, maybe I won't steal your thunder, but if you could just elaborate a little bit on what you meant by that comment.
yeah, so like slowing growth while inflation is rising or disinflation is slowing. So if you take like Canada, for example, heading into the conflict, you could categorize Canadian growth as slowing or, relatively weak, excess supply in the economy, job losses are growing, trade uncertainty with the US. So a very different backdrop perhaps than recent past. inflation pass through from higher oil prices is kind of the, I guess, the scare there. So you have this in Canada combination of a weakening economy or a weaker economy with rising potentially inflation as well. In the US, the US entered the war, I would say, as, with an economy that was kind of, chugging along at trend. AI infrastructure was part of that. Tax cuts and stimulus from prior periods were supporting the economy as well. You had a labor market that's, probably weakening, or one could say that, but still a lot of stimulus in the background. And then you have this, oil shock potentially driving inflation. So that's kind of it. I mean, sort of both sides would be tough for equities and bonds together, right? Is kind of the scare from a portfolio perspective.
Right, and just, I guess, to be clear, it's not that we're not calling for that scenario, we're not calling for specific economic scenarios generally, but, I think at the margin, the point is that certainly the risk of that kind of a if you think about probabilities of different market outcomes, that all else equal, you gotta imagine a stagflationary environment, at the margin at least, has become more likely, and that's, one of the concerns, I guess, right now.
For sure. I think it's important to point out, like you said, right? Like we're preparing for potentially multiple scenarios, right? Like how this could play out over the coming days, weeks, months, quarters, that the near term impact, the longer term gain, it's quite variable, right? So, from what you're seeing, certainly over the last, quarter or two, or before the conflict, like from your seat, like some of those changes that you would note in, our process or our, you know, stock selection, how we've adjusted or came into this adjusted already or are adjusting as we go through this conflict and crisis.
Yeah, I mean, I think one thing we've talked about this, we might have talked about it on the last podcast. Certainly, I think in other episodes of this podcast and other publications, we've talked a bit about this, and this is not our own idea. This is, I think, widely accepted. This concept of a changing world order. This sort of, well, at least historically, you had, post World War II for what I guess the better part of 80 years, relative stability. Certainly conflicts here and there, but nothing at a sort of global level that sustained itself for a very long period of time. Um, uh, as a result, increased globalization, sort of all your Econ 101 concepts, right? Like comparative advantages, really focusing on what you're good at as a country and producing as much of it as you can at the lowest cost and the best quality, and exporting it around the world. And so that's been the backdrop for the last 80 years. And I think what we've seen over the last certainly the last 12 months, but even over the last couple of years, you can go back even to 2022, I think that's probably where the shift really started, is some of that breakdown, right, in globalization and increased levels of conflict. And there are, to your question, I think, was around process and sort of what we're looking at. I do think there's some changes, not necessarily in the philosophy. You're still looking for the same sort of companies, but when you think about, we're quality investors, so we're trying to generate returns through or by selecting businesses that, can generate a good return on capital. When you think about it from a forward-looking perspective, though, in terms of quality, some of these shifts, the changing world order, realistically, I think it probably does lead to a change in the sort of businesses that you would think are high quality. So the obvious example is defense. That's changed over the last couple of years. Historically, we didn't tend to invest in that space. Very relatively modest returns on capital, and that's obviously changed meaningfully as defense budgets have sort of skyrocketed the last few years. Don't necessarily see that slowing down anytime soon. Commodity producers would be another example where we have been leaning a little bit more into that over the last I would say 12 to 24 months, both on the metals, the mining side, as well as the energy producers. And that's been good for portfolios, certainly. Obviously, we weren't expecting what's happened in the last quarter necessarily, but, as sort of resource, independence and security has become much more of an important issue, that's all else equal, additive to those types of business models, so we have leaned in there, a bit as well. So, yeah, very similar or same approach as always, but the sort of businesses that meet, the quality standards and the return potential standards, that shifts over time. That has been a more noticeable change over the last, I would say, kind of year or two.
And broadening out too, right? To that is broadening out exposures and broadening out diversification so that, we're positioned for multiple outcomes potentially, but also increasing opportunities for us to potentially take advantage as scenarios change, right? So increasing, uh, the number of holdings, in certain strategies to diversify away and into some sectors that we may have, like you said, traditionally not been weighted in, or reducing those underweights or reducing overweights. So call it that broadening out, right?
Yeah, exactly, exactly. Why don't we talk a little bit about performance? So you've kind of given a good setup in terms of what happened or what may have impacted equity returns. If Why don't we go into there, and if you can tell us a little bit about what happened in the quarter as far as the equity markets were concerned.
Yeah, for the equity markets. So, you know, the the headline numbers would suggest, that things were kind of calm, I guess, if you looked at just quarter results, which would say anything. But if you looked at it from like a sector basis, a regional basis, and then obviously, as we do as individual names and companies, it would be a very different story than just in the aggregate. But, the standout from the equity markets would have been the energy sector, which also helped Canada. So Canadian equities and developed international equities did well this quarter, outperforming US, which was an extension of what we saw in the trend that we talked about last quarter in this podcast. The US big cap names, the cap names, or the hyperscalers, you call them, their spending or their increased spending and capital expenditures was coming under some scrutiny in the quarter, as well as disruption from in AI towards the software sector. So specifically, there was a research paper from Trini Research, which drove a lot of doubt as to the future or the future cash flows and terminal value of some software companies. So that was a bit of a change and shift over the quarter before the war and since. Interesting though, like the gold trade and fixed income or bond yields both kind of moved how you wouldn't have expected them to as a traditional, more safe haven vehicle. So gold, has typically held up in those types of environments, and it certainly had declined from its peak in January, and bond yields did rise on the margin. So over the quarter, there was a lot of shifts underneath the surface, and then the Iran conflict kind of triggered that, right? As energy shock, potentially higher inflation, and then the impact that could have on central bank cuts, which I'll let you to kind of talk through that. But from a performance perspective, we did see that the quality oriented portfolios that we run at More, for the most part, didn't keep up with benchmarks in a quarter. So there's a quality issue as well. So quality typically as a style has underperformed more recently. It's tracked and held up with the broader markets when markets typically start to deteriorate, and then recovers strongly, usually when markets kind of reassert themselves. So that's something we're keeping an eye on. But the underperformance is also a factor of what's traditionally been or historically been more recently the momentum driven markets, concentrated markets. And then, like I said before, this AI driven disruption going from software to also freight and asset light business models as well, which kind of drove some disruption.
So there's a lot to unpack there. You talked about gold, you talked about rates, you talked about a few different sectors and themes. Why don't we start with gold? You mentioned it didn't behave necessarily as the safe haven asset that you would kind of expect in a period like we just saw in the last quarter. Kind of what's your view on what explains what happened in the last quarter? Is it just a function of what what we've seen over the last few years, and it was just so hot, or is there something more to it?
There's probably some of that, like the chartist in me would look at that and say, like, yeah, that seems like in hindsight it could be the case. There's some mean reversion in that, but probably not a fundamental breakdown, I guess. Like if you look at some other indicators over the quarter, there's potentially, was some forced deleveraging that happened. So investors forced to raise capital as financial conditions tightened. Gold in its certain forms has been more liquid. Demand from Gulf countries as well, or sovereign demand slowing as you saw fiscal obligations are still high, but energy flows are disrupted. So there's some talk or some indications that those were also potential reasons for the downdraft that we saw in gold price. But you kind of saw this before. If you go back to '08 and 2020, gold did sell off sharply in those crises, and then what looked like as a failing hedge, but it was really more shorter term. It's tough to say that that's the case now. We won't know, but it seems like some forced selling has occurred, but longer term deficit spending, energy scarcity, elevated inflation risk, those things are still there. So, I still think that there is reason to hold gold, and maybe in the short term, it's sold off for other reasons other than fundamentals.
That's fair. Yeah, some of those long-term drivers, as you said, haven't really gone away, but combination of the valuation had moved up so much, and yeah, some sources of liquidity, I guess, for investors' portfolios. The other one thing you mentioned is just around the bond markets and kind of the impact inflation might have had on there. So maybe I can speak to a little bit to that. Both the Bank of Canada and the Fed were on the sidelines in the quarter. So Canada's starting point, the overnight rate is lower at 2.25 versus kind of roughly, I think it's about 3.5 or so in the U.S. So they had a higher starting point. Both central banks stayed on the sidelines. Partly, they've already did a fair bit of cuts in 2025, but then obviously as the quarter wore on, there was this political issues that we mentioned earlier, and of course, then the knock-on effects on inflation. So all else equal, yeah, the banks didn't move. They did indicate that they're kind of on a wait and see. Basically, to the conversation we talked about earlier, sort of that tension between rising inflation expectations, but not necessarily clarity as to whether it will be the T word, transitory, I should say. But at the same time, the longer it lasts, obviously might impact growth, right? So they're trying to balance those two forces. If they step in now and start cutting, and this sort of the situation resolves itself, then you've relaxed monetary policy perhaps earlier than they needed to, and particularly if you end up in a stagflationary environment, higher inflation, lower growth, then that's a really tough position to be in. If they've already been cutting aggressively, they don't necessarily have as many tools in their toolkit to use. So yeah, that's certainly been a big factor in the bond markets in the quarter. As a result, when you talk about yield curves, they flattened. So the yields generally across the curve went up. Just as a again, so to that comment you made earlier around bonds not necessarily acting as a safe haven. They sold off when markets were selling off, but it was really more of an inflation concern. And so, yeah, in the short term, it didn't necessarily provide a great hedge. And then in terms of the flattening, basically what that means is you had front end yields, so shorter duration bonds, 1, 2, 3, 5 years, as opposed to 10 and 30-year bonds that moved out more. So the yields went up by a larger magnitude than the long end. And that's simply a function of if you're worried about near term inflation, and you're worried about potentially flipping from rate cuts by the central banks to hikes, that's going to naturally impact the front end of the curve more than it'll impact the long end, because long end is more a function of long-term growth fundamentals and long-term inflation. And I think, generally speaking, both the central banks and the market, the view is that if there's a resolution relatively soon, you shouldn't get multi-year growth and inflation impacts, but you are getting it right now in the short term. So that's simply why you've got this big shift in the yield curve at the front end and not so much in the long end. But overall, given it yields were kind of up across the board, that's not great for bond investors. So that was a headwind in the quarter. And then the other big piece is just around spreads. And we did see a bit of spread widening both in global investment grade, so higher quality bonds, as well as in high yield. Combination of factors. So the geopolitical tension is not helpful, of course. Growth concerns, which we've already talked about. And then I can't remember if you might have alluded to private credit already, but that, certainly there's been a lot of headlines right now around private credit, lending to software companies, investors not necessarily being able to get their funds back when they want. That's not necessarily bled directly into investment grade and high yield markets. But all else equal, I mean, they are correlated markets. Borrowers that tend to play in the private credit market, they also tend to overlap in the broadly syndicated loan and high yield markets. So certainly, what if happens in one market does have a knock on effect on others, and then just generally a risk off tone also affecting spreads. So as a result, a little bit of a sell off in terms of the price of corporate credit securities generally. So a bit of a tougher period for bond investors. But yeah, I wouldn't say you've even already seen a bit of a snapback in yields just in the last week or two since the end of the quarter, as that news of the potential ceasefire was announced.
When I said gold, people were doubting gold as the hedge, and like I said, bond, like you just explained. When you hear people say, "Well, I hold bonds in that portfolio in those proportions," is it is still playing a role in portfolios today? Traditional diversified fixed income, right? What sort of pushback would you give to that statement? Because it seems like some, and whenever yields are rising and equities are falling, people say exactly, well, I own bonds as a diversifier in equities, but we typically look through a cycle. But what are your thoughts on that?
Yeah, I think the general view or house view would be in terms of asset allocation is different asset classes play different roles in different regimes. So one asset class is not going to perfectly hedge you or provide a hedge in all environments. So as I said, we are kind of in a potential inflationary shock situation. Well, in Canada for sure, you've got slowing growth, so that stagflationary scenario that we talked about is the risk of it is increasing, and so in that environment, it is tough for bonds to provide a hedge because the central banks can't provide as much monetary support by cutting because they've got to worry about inflation. You don't usually cut when inflation's a concern, or at least you can't cut as much. That's certainly not a reason to not have bonds. What I would say though is that diversification is the only thing you can sort of do to protect yourself, and so that applies to asset allocation too. It's not just within a given just within stocks or within bonds, but actually, or sorry, across asset classes, but also within them. So we've added global credit to our balance mandates about a year ago. That's going to do well in certain environments and not so well in other environments. So in a period where government securities are going to do really well when they're really aggressive, there's a risk off environment, they're cutting rates, that's going to be very additive to have core fixed income, to have traditional duration, probably less so to have credit. But the flip side is if you don't get that major sell off in spreads, then it's quite helpful to have some global credit because you've got a meaningful yield advantage. And then also the way that strategy is run, you've actually got low duration. So, higher duration in your traditional fixed income, quite a bit lower duration in your, so your global credit, non-traditional fixed income, whatever you want to call it. They're going to do well in different environments. Over time, that should produce a better result. That's kind of the sort of asset allocation 101 is you get different allocations that have different correlations, different risk profiles that do well in different environments. And so, yeah, no, I definitely would not say that it's diminished the reason to have bonds, but it maybe is an indication of, for investors that aren't necessarily as diversified as they could be in their fixed income, that's probably a good next step would be to think about how do you diversify within your fixed income.
Yeah, well said. I would agree for sure. You touched on software a little bit too, and I did. I mentioned it in my kind of macro comments. Did you want to talk about that a little bit more? Like, specifically what is kind of maybe happened to software, maybe how we've reacted in some ways in portfolios?
Yeah, sure. I mean, software has definitely been challenged, software as a service providers in particular, but software more generally. This wasn't the first quarter where that was the case, but it was certainly acutely felt this quarter. I think what maybe shifted or was a bit of a change quarter over quarter is that it started to broaden out. It wasn't just the direct software providers or the data providers to those software, but a lot of other business models that maybe at first glance don't necessarily seem all that connected, but they sort of got caught up in this sort of AI loser, being basically concerned about AI disintermediation. So that's on the consultant side, even insurance brokers, wealth managers, a lot of different financial services, anything really that's data heavy and or technology heavy, not necessarily a pure tech stock or a pure software provider, but anywhere where at the margin, theoretically, the idea is it becomes easier to disintermediate these businesses by upstarts because of the, basically being able to use LMs and AI to sort of put together programs that can make it easier to have an upstart company. So either to take away market share, or even if the incumbent's not necessarily losing a lot of share, putting pricing pressure. And so that's really what we've seen this quarter is that broadening out. So it's caught up a much larger swath of of stocks and business models. The one thing you alluded to earlier about quality businesses, a lot of quality businesses tend to be asset light, or at least historically have been asset light. And so when you think about all the different businesses that I mentioned, whether it be consultants or the wealth providers, insurance brokers, those tend to be asset light businesses. So historically, we've tend to had a lot of exposure in some of those businesses, and that's you alluded to this earlier during the performance section. It has been difficult right now because a lot of those businesses are being seen as losers in the short term, not necessarily because it's actually reflected in the fundamentals. Their earnings have not necessarily deteriorated, but when you think about trying to discount future cash flows, I think that's where the market is. There's a lot of sell.
Shoot first, ask questions later.
Yeah, exactly. You're guilty until proven innocent. And so I think what we've been trying to do is really think through. And I think one of our analysts, this might have come up on another podcast, but just to sort of reiterate for those that didn't hear it on previous podcasts, we're sort of looking through and trying to figure out characteristics that we think as we sort of sift through these business models, how are we sort of assessing? And we have sold some, we have trimmed, we've actually added as these stocks have sold off. And really the criteria we're looking for are things like, do you have enriched proprietary data sets that are very difficult to replace, deeply embedded in customer use cases? All else equal, you probably have a better chance coming out on the other side of this in a fairly good position. Do you have high operational entrenchment? So that would be things like you're very integrated in your customers' workflows. It's harder to remove that software for an upstart, or at least it's seen as risky. It's not worth necessarily the risk of doing that. And then is it in an industry where the risk of hallucination is high? So think about heavily regulated industries, healthcare, things like that, where, again, there's greater risk to trying something new as opposed to sticking with the incumbent who can adopt AI tools themselves, maybe have a better offering, maybe offer it at a lower price. But again, that should hopefully slow down the risk of disruption. So we've made quite a few trades around a lot of these themes and across our mandates. But that's sort of how we're looking at it. So it's not a wholesale retreat from these software names and from these sort of other business models. But we have had to be discerning. We have made quite a few portfolio adjustments. I suspect we'll make more over the next few quarters as more data comes out and as we get a better sense of which business models are holding up and which are maybe more likely to be disintermediated. But yeah, it's definitely highly topical, and I imagine it'll be for the foreseeable future.
Yep, well said.
We've covered a lot of ground. Do you have any sort of final thoughts that you wanted to close with?
Yeah, I think the immediate issue we started talking about was the Middle East and how that's a wild card. There's different outcomes. It could be containment, prolonged shock. It could be broader escalation, de-escalation. Perhaps the market hasn't priced all of those in yet, or favored one or the other. And you go back to what we've written about and talked about previously, which is this is not sort of an isolated shock, and those old assumptions around globalization or stable globalization and low inflation, capital like growth are kind of all being tested. So, we're set up for, potential more disruption or less disruption, which is important. And our process, as you said, is unchanged. So really looking for competitive advantages, durable returns on capital, and disciplined management teams to execute. And the playbook may be updating or updated, but the broad diversification, the careful sizing of positions that we talked about, those have certainly updated, but not the process. And I think, in a world of uncertainty, and that discipline, active management approach and quality approach that we have is really what matters and carries people through to the other side, which will come.
Awesome. Well, that's probably a good place to stop. Thanks very much. Great talking with you, Stu, and looking forward to next quarter.
Yep, you too, Kevin, for sure. Thank you.